Hello, this is Ed Butowski. Welcome to Wealth Transparency. I have as my guest today Andrew Tang from Turner Investments, Michelle Connell from Portia Investment Management, and Bill Lane from Ethos Financial Group. And I want you to really embrace what these people have to say. What we're taking are headlines that don't necessarily get the biggest amount of attention, and we talk about how and why people should pay attention to what these people have to say and how these headlines might impact your portfolio. So to start off with, Andrew, Nvidia and Applied Materials both announced spectacular earnings, but both stocks went down. Why is that?
Well, I think the main reason is that there's still tremendous amount of fear in the market. The president, of course, doesn't help in this case. Every other hour, there could be a new event and, new tariffs and new surprises. And Wall Street and investors hate surprises. So whenever there is this high level of uncertainty, a lot of the technical aspects takes over in terms of trading. And so you have these big institutions that are dictated by algorithm and technical signals. And on top of that, fundamentally, we are still revolving around this question, are we in the AI bubble? And so even though the proof is in the pudding, Jensen Huang came out and said that the market got it wrong. We are still in the second inning of this transformation from general purpose computing to accelerated computing, and there are multiple waves that are coming through, but we still need to show the proof. And so far, the earnings are deemed not sustainable until it's proven otherwise. And that's why you have these kind of sell-off, even though they guided well, they reported well, but it's just that the street doesn't believe it.
So Salesforce, Bill, is another one where there was mixed guidance, weakening confidence in the enterprise software growth market. And a lot of that has to do with the overwhelming demand for AI, thinking that Salesforce and how they make their money is going to become obsolete. What are your thoughts on NVIDIA, Applied Material, and Salesforce?
Well, I'll take the last question first. So I think we need to look at Salesforce as part of the transition that SaaS is undergoing right now. And typically SaaS companies, you've expected 75, 80% margins from their very sticky products, which have long-term contracts for their customers. What Anthropic and other AI native systems are coming forward with is the ability to get the same jobs done via software in a jobs-based pricing model that may only have 50 to 60% type margins, and the cost of goods sold, the reallocation of compute, is the biggest constraint to those companies and their ability to grow. So we're in the midst of a transition in terms of the profit margins of all these companies. Whether you're AI native or not, there is going to be significant profit margin pressure. Either build it yourself or, hey, maybe even the business model at Salesforce needs to transition to one that's more agentic and job-based.
Yeah, Michelle, you've been at this business for quite a while. Do you recall a new technology that could negatively impact earnings for companies more than AI?
No, and I started out as a semiconductor analyst in 1997 and headed a technology sector for a large bank before the tech bubble blew up. So to answer your question, no. I think the issue is with the semiconductor stocks like NVIDIA and AMD, the amount of capital, the build out. You look at what NVIDIA said they are going to spend going forward versus what they said last year. There's a differential of about at least $50 billion. That's a lot. At the same time, you have AMD and Meta that have put together, they'll be working together rather going forward. That doesn't mean that they're going to be eliminating, Meta's not going to be eliminating NVIDIA. So you have a lot of pieces that are moving, and stocks that you thought were going to be almost a monopoly, that's no longer the case. Looking at Salesforce, I think it's still been so beaten up in the last, along with all the other software stocks, but it bounced back today because they said they're going to increase their buyback, they increase their dividend. And I think also the fact that Anthropic came out a few days ago and said they're going to use Salesforce in their plugins. So it's having a little bit of a relief. I think it's kind of It is interesting what Bill said regarding the margins. I think we have to look at that before you jump into that name.
Yeah, because people forget that earnings are what drive stock prices higher. And if AI, which is basically free, is going to put a wedge into the earnings multiples, you really have to study in great detail exactly how AI is going to be used by each company. And Salesforce seems to have a kind of a target on it because it's really one of the premier enterprise software companies. Andrew, last week we talked a little bit about consumer confidence, and it improved in February after a slump in January. Can this be a signal for buying opportunities? And does consumer confidence, people sometimes mistake consumer confidence for investor confidence. And I want to kind of dissect both of those.
Yeah, it's a great point because we are actually having a very different growth path for consumer confidence and investors' confidence. Investors' confidence is actually all-time high, while consumer confidence are really all-time low, and that really goes into the K-shaped economy, the K-shaped consumer market, that the higher income earners, they're doing better and better, equity owners, and then versus those that are living paycheck to paycheck, unfortunately. Consumption market, consumer-centered market reflects that. And that goes hand in hand with job security as well. As AI are becoming more and more a household phrase, we also see corporations across the board are cutting their labor force, complete opposite of what happened to 2022, that you just got to hire at all costs. That's a completely turnaround, and we're trying to offload that, extra human capital there are many firms are carrying. And so I don't expect consumer confidence going to play too much of a role here when it comes to applying to the actual consumption as part of GDP. It is still 70%. I think a lot of the purchasing power, as we look back at the previous data, it's hidden because most of these are all computers and equipment, right? And those large ticket items, the big ticket items that are coming from capital expenditure, completely offset those at the consumer level. The beauty of the current consumer is that we are just empowered by such technologies that we have amazing choices. So we can spend down, and we have various retailers and shops that we can go to. So the choices are plentiful for the consumer at all levels. And so I wouldn't play too much into this consumer confidence. It will stay low because it's a reflection of the job security and income security. But overall, we still see a robust consumer market, largely because of the insane amount of capital expenditure that are coming into corporations that we haven't seen for decades.
Yeah, it is amazing. Michelle, we were talking earlier about, you said, 50 billion. That just rolls off your tongue. But, 10 years ago, 50 billion was a lot of money. So, Bill, I want to talk a little bit about the Supreme Court ruling against Trump's tariffs and what that has done to the overall market, if it's done anything at all.
Well, the answer is very, very little. And there's a lot of noise about refunds for tariffs and other things. I don't think any of that ends up happening. I think that's 3 yards in a cloud of dust right now and position. I'm not a legal expert on Supreme Court law, but this to me was much more of the mechanism utilized, and it gets instantly transformed into whether tariffs were the right thing to do and the Supreme Court's ruling against it. Remember, the Supreme Court is just talking about the mechanisms by which policies are enforced, not the policies themselves. So I think there will be, as Mr. Trump is known to do quite well, a pivot and a reapplication of tariffs in other ways. If anything, at first you don't succeed, try again in a different way is kind of the modus operandi. So I don't think it's going to create any sort of economic change that, whether you're looking for relief from tariffs or you're looking for improved fiscal positioning in the U.S. because of tariffs. I think we are exactly in the same spot that we were in on that 2 weeks ago.
Yeah, Michelle, I want to step back and talk a little bit about the Department of Energy and the amount of energy that's required for these AI data centers. And that the idea is that the Trump administration is going to allow companies to create their own energy sources. Do you think this is going to be a disaster, or do you think it's going to be a real positive for electric companies?
I think they're going to have to do something because in the areas where you have the highest concentration of data centers, electric bills are just going through the roof. So when you saw Department of Energy stepping in and saying they're going to give a loan to Southern Co., and those two states are heavily concentrated in Georgia and Alabama, and then you look at the metrics underneath of the population, you've got a lot of poverty there. So how are you going to push all this cost on people who have no discretionary income? They may not be below the poverty line, a lot of them are, but you've got a lot. They can't afford these bills. So Trump has to do something. Is it going to be messy? Yeah, it's probably going to be really messy because we've never been through this before, and we know whenever the government gets involved, it's not.
I'm from the government and I'm here to help. Is the
Exactly.
most dangerous phase you might hear. I do think, just to preempt you, Ed, and latch onto that, the innovation that's happening in small modular reactors and other power generation is 100% necessary to satisfy this requirement of on-site power. And that won't be the immediate reaction to some of these policies because the tech's still a long ways off. But in the long run, if we get there, you bet it's going to be well worth the dollar of loan invested today to make it happen.
Yeah, and I don't know what the cost is going to be, but the amount of money that they're looking at spending on CapEx, I can imagine that the energy is just going to be a rounding error for a lot of these companies.
Well, it's about time, okay? And then there's a new term, like you go into the restaurant. This is BYOP, bring your own power. So I think, echoing what Bill says, SMR, absolutely. But we are really, really behind in electricity generation, and we should really embrace on solar and battery storage. I think it's happening behind the scenes. I think there are deals that are going to be done behind closed doors. It's just that, we're not hearing it. We are grossly behind China. And China, it's producing the most amount of electricity right now. And I'm very happy to hear that we're moving in this direction, that, we're embracing, and the government is providing loans, there are favorable terms for this particular infrastructure, to grow. Absolutely amazing.
Not to get political, but it's really nice to have a president who is on the cutting edge of just about everything business related. Regardless if you approve or disapprove of his policies, it's nice to hear somebody talk about things and bring them up to the forefront, which then brings me to another direction, and that is that the 30-year mortgage rate dropped below 6% today. So when you look at the whole economy, you see that we have slow GDP growth, which really surprised me, how slow the GDP growth was in the fourth quarter, which kind of supports the idea of lowering interest rates. Previously, I thought with a high GDP, we could not support lowering interest rates. But on the short end, we can lower interest rates, and that's going to bring down the 30-year mortgage as well. Bill, you want to touch on that?
Well, I think it's an exit opportunity if you own bonds, quite frankly. There's still more that needs to be done in order to get housing affordability, which is a huge driver of all of those consumer expenditures inside the economy, and even a huge driver of that consumer confidence, if we're just to tie all of our topics together. A 6% mortgage is historically cheap and historically affordable. We're just coming from an environment where that hasn't been the norm for better than 15 years. Buyer expectations need to adjust to a new reality, and savings practices of the generation that wants to acquire a home also need to adjust to the new reality of a 6%.
Yeah. So, Michelle, what are your thoughts on the 30-year mortgage rate dropping below 6%?
I think it helps. I think it's a threshold that you'll be looking at maybe an additional 5.5 million to 6 million additional sales of homes, which helps. I think it needs to go lower for it to be, for homes to be considered affordable. Is that feasible? I don't know. But when you consider we are at almost 7, last year, and now we're at 6, I think that's wonderful. But I think we have a ways to go. And then we also have the supply issue as well, right? So even if rates come down, housing is still really expensive, and we need to get more supply on board.
Yeah, you brought up the word affordability. I wrote a Substack that nobody's read, by the way, but I wrote a Substack called Affordability and Predictability. And I think predictability is right in line with affordability because people don't like surprises and they want to know what something is going to be so they can plan their economic lives. So one, this is a kind of a cheap way for me to plug my Substack. But two, I think that when you think about affordability, predictability, and knowing what something's going to cost at the grocery store and what your car repair is going to cost and so on and so forth is really, really important. So Andrew, in conclusion here, what thoughts do you have that you want to share with everybody?
Well, I think we're at a very interesting crossroad between amazing growth and uncertainty. I always thought about the theme of what can go wrong, and rather, why don't we think about what can go right? There are a lot of things that are happening right now that are really good for the economy and for the future. You know, I can just name a few. Obviously, the capital infusion during the State of the Union address, it was claimed to be 18 trillion. The White House official report 9.7 trillion. But listen, even if you discount it all the way down to 5 trillion, it's still amazing money raised for country. And then you have the creation of the Trump account for kids under 18 years old so that they can start to be an owner, and then fund it with $1,000 account. And then amazing, you know, Michael Dell coming in with a $6 billion of contribution. These are all amazing things that are happening. And then you have the regulations that are improving the M&A activities. I have to stop here. Otherwise, I'll keep on going for a while. But I really beg the question of what can go right versus what can go wrong for this year.
Great. Bill, you have any closing comments?
It's interesting to me from all the different things that have happened thus far, 2 months into the year 2026. Our investment strategies are essentially unchanged. Avoid bonds, buy commodities, buy growing companies, and invest where you have operating leverage to take advantage of all the growth stuff that's being thrown at the market that Andrew's talking about. Despite all this back and forth and all of these kind of changing narratives, a lot of the core macro positioning remains unchanged. And you got to stick with it. You got to dollar cost average and continue to keep stacking these positions in an opportunistic and risk managed way.
Yeah, a lot of my clients are very fearful. And I agree, Andrew and Bill, that we need to look at the positives and not look at the headlines that come out of some of the people in the media making everyone fearful. Michelle, do you have any concluding remarks?
We live in a period of time where we have such innovation that it's just phenomenal what kind of opportunities we have in front of us as investors. And so we've never seen anything the likes of this. I'd say it's even bigger than the internet. So as both Andrew and Bill said, lots of opportunity. We always try to balance things out and see what can go wrong. But I like the fact, let's focus on what could go right, because we have a lot of opportunities in front of us that we may not have had before. But within those opportunities are opportunities for increasing your wealth by a large degree.
And what we do for a living is we have clients who are always fearful that they're going to lose money. So we have to address that all the time, and we have to readjust their thinking into all the positive things that are out there. So with that in mind, I want to thank everybody. Andrew Tang, Michelle Connell, and Bill Lane. Please, if you're watching this, which obviously you are, reach out to these people if you need any financial advice. And I appreciate you doing this, and we'll look forward to next week. Thank you.
Thanks, everyone.
Thanks, Ed.
Thanks for having me.